And welcome to our special segment, Bull versus Bear, where we look at what's impacting markets and the economy. Here in the United States, inflation data rose less than predicted for a fourth straight month. The Consumer Price Index saw a rise of just 0.1% in May, below the consensus estimate. The results helped to lower worries over price pressures tied to tariffs. In a prepared statement to the House Ways and Means Committee, U.S. Treasury Secretary Scott Bessent emphasized the role the Trump administration has played in the improved CPI numbers.
Inflation in the U.S. is at its slowest pace since 2021, and the numbers we received today take us back to the slowest pace since 2020. Most importantly, we are decelerating cost increases for shelter, food, and energy. After 4 years of price increases diminishing the U.S. standard of living, inflation is showing substantial improvement due to the administration's policies.
Bessent, who had just returned to Washington after trade talks with China in London, said that President Trump's tariff policies had challenged a, quote, decades-old status quo on trade. Well, U.S. stocks paused on a recent rally on Wednesday as investors continued to digest that softer than expected inflation information. The Dow closing today flat, tech-heavy NASDAQ leading declines, falling roughly 0.5%, S&P 500 falling just under 0.3%. Investors also spending the day assessing Tuesday's trade framework between the United States and China, and of course, we are going to have a lot more on that later. Okay, for more on the state of the U.S. economy, right now we're joined by Michael Collins. He's the founder and CEO of WinCap Financial, as well as an adjunct professor at Endicott College. Michael, good to see you. Thanks for coming in.
Thanks for having me on, Sean.
Okay, your thoughts on today's number. It came in lower than expected. What's behind it, and what else really jumped out to you about this report?
Yeah, the numbers did come in lower than expected. I think we've generated about $70 billion of tariffs since the start of the year. And the question a lot of investors have on their mind is that where is the impact of that $70 billion, in the market? And we have not seen it yet. Some of the biggest pain points for this month was that housing, shelter, and grocery costs were higher than expected. If you're diving deep into the numbers, after grocery prices, after declining last month, showed an increase, I believe, about 0.3% this month. And then on the downside, just in time for summer, gasoline and airfare prices tumbled.
Right.
So, good for that consumer spending on that side and making people's dollars feel like they're going further.
Let's talk more about the tariffs, though. Clearly, a big percentage of the population is waiting for the other shoe to fall. Do you expect there is going to be a more pronounced impact, or do you think the Trump administration has been successful in its efforts to soften the blow of these punishing tariffs?
Yeah, it's too early to tell. We've heard that the UK trade deal was a good trade deal, and if that's a baseline for a good trade deal, that means a 10% tariff across the board. A 10% tariff will have some impact. However, that impact might be offset by declining interest rates by the Fed. So it makes it much harder to determine. I saw a Trump report today that the trade deal with China is done with little details, so TBD on that. However, everything is still in flux. We've seen an environment where things start to get calm and then things get inflamed. For example, the European tariffs, are still, I think, set to kick in, potentially in July. But if China's a model for the European deal, then the high number that was threatened, the real number will be much lower. So the market may view this as positive. But you've seen companies such as Microsoft's Xbox and Lululemon already increase prices based on the tariffs that are currently in place.
Yeah, and Michael, some other information out. The U.S. deficit just continues to balloon. Never mind the fact that Trump added more in his first time in office than any other president, and now it looks as though the shortfall of what? It's up from 14% from a year ago. So just how bad is this going to be?
Yeah, I mean, I'm more of the belief that as long as the U.S. currency is the reserve currency in the world, the path of debt is concerning, but the level of debt is not. and it matters less than kind of like the headlines would make people believe. And, everyone's against spending when it's the other political party in charge of the wallet. And then when you're in charge of the wallet, you justify any spending you need to make, which kind of shows you the path of increasing debt. And that's just the reality of the numbers, not a political take.
Indeed, that's a very fair point. Okay, we also had this very, very public flame out between Trump and Elon Musk. What does that mean for the Department of Government Efficiency, or DOGE? And this is a unit that had already been widely criticized for not coming close to delivering what it had promised.
I mean, you hit the nail on the head there, Sean. I mean, they didn't accomplish their stated goals. So, what does this mean for DOGE going forward? I don't know. I don't know what this means for DOGE going backward either, because if they didn't accomplish their goals, this almost looks like a corporate layoff, right? You didn't hit your goals, you're out of here. As far as Tesla's impact, we saw Tesla stock rise on Elon Musk's friendship with Donald Trump, and you might see it further decline if their relationship deteriorates. A lot of Elon Musk's revenue depends on government contracts, and if he sours those relationships, those contracts, as Donald Trump has publicly stated on Truth Social, that he has no problem cutting those contracts.
Yeah, and we're also talking about his very important SpaceX contracts as well. So what will the Fed make of today's report? Because so many people are going to be checking that for the outlook for next week's meeting.
I think a lot of people are very concerned on a month-to-month basis in the long-term scheme of things. The Fed right now, I think the market predicts, is almost or close to 100% chance of a rate cut by September, and I believe that. And whether they cut rates in June, July, or September, from the long-term pace of the market, that's relatively irrelevant. Now, the market has started to call in question whether we're going to have even 2 rate cuts this year. If we have the first rate cut in September, we might not have the second one until January. But again, that's because a lot of times the market focuses, I think, irrationally on calendar years.
Right.
The path of rates is still down from here.
Michael Collins, always a pleasure. Thanks for your insight.
Thanks for having me on, Sean.